Good morning, Internet. My name is sᴛᴛＳᴛs, and I am one of eToro's most copied popular investors. Today is Friday, and that means it is time for my weekly review. So just to talk about stats very quickly, the S&P 500 has made some decent gains over the past week. So year to date, it is at 4.88%. The S&P 500 is my benchmark. I try to beat it by 20% each year. The 12-month return for the S&P 500 is currently 45%. Not too bad. All right, let's look at my stats and the week in review. March has been volatile, let's call it that. There was a bit of a decline that started in February and it's continued through March, but the month to date is nearly 2%. The year to date for me is 10.5% roughly. My 12-month return is 63%, so just about beating the S&P 500 by 20%, 18% or so. And my lifetime return at the moment is 651% over 6 years on eToro. So if you'd invested 10,000 with me in 2015, you would now have 75,000 pounds, which is pretty great. All right, so that's enough about stats. Just today, looking at the markets, looks as though tech had a great day yesterday and has had a great week. And I'll talk about this in a moment, but you can see it's selling off a little bit today. And it looks as though money is probably going back into the S&P 500 and the Dow Jones, which has been a pattern up until this week. So something that I have been talking a lot about this week is adding funds. So you will now see my accounts being bumped up fairly significantly. Thank you for your patience on this. I had to make a bank transfer, which means I couldn't control when the money landed. And unfortunately, it landed on the worst possible day, which was Tuesday. And because a huge amount of cash hit my account on the largest jump in the NSDQ in a while, it meant that my returns were a little bit diluted on the day because I was massively in cash. But this probably didn't affect you copiers because you wouldn't have added cash. The bulk of you, I don't think you did anything. And so your returns on the day would have been fine, but my stats are probably 1% lower than they would have been if I didn't add cash. So I just wanted to explain that a little bit. I also wanted to talk about what we saw on Tuesday. So Tuesday was an enormous jump in gains for the NASDAQ in particular. So where's Tuesday? Yep. So a nice fat green candle. And a lot of people have said that was because the NASDAQ was oversold, and it was, right? The NASDAQ had set quite a few records in terms of selling. But what also had happened is that there was a huge amount of short volume on the NASDAQ and tech stocks. And actually, a lot of the long volume, a lot of the long sales, a lot of the purchases on Tuesday were from individuals or institutions covering their shorts. So a lot of people had shorts on the NASDAQ, and they felt that they wanted to get out of their shorts because it felt like the market had bounced or was going to bounce. And whenever you unwind a short, there's a purchase that happened. So actually the ratio of short covering to people that were just buying stocks was 4-1. So that's made me a little bit cautious. It wasn't a purely sentiment or fundamentals based bounce. There was a lot of short covering involved then, and I don't think everyone's realized that, and they don't care. As long as whatever moves the market changes sentiment, when it does, the market will continue in the direction that it was going. But from a technical perspective and from an underlying sentiment perspective, this has made me just slightly nervous. All right, so if we look at this heat map on Finviz, can I zoom in here? Is a pretty good way to gauge where money is moving from and to. And we can see on the 1 day, this was yesterday, obviously, because this is looking at the S&P 500. The tech was a big beneficiary of, and so it's a little bit of a counter rotation that we've seen over the past few weeks from tech into other value and recovery stocks. And that's fine. So from the 1 week, we can see that everything is just about gained. And on the 1 month, I think we'll see that you can see the rotation out of tech has happened here. Now, I don't think the rotation is done. I think we've probably seen the most volatile part of it play out already. But I think that we're going to see a seesaw between tech and value and recovery for a while now. So I think we're going to probably see money moving between the two of those. As one will ride up, and then money will move from tech, for example, if tech has gained a lot, into the other sectors, and vice versa. Something to note is that the market is still very expensive. If we look at a few of the quick value measures, so PE, price to sales, it's more on tech, price to book, which I don't put a lot of value in. We can't see cash flow, but we can see that things are still expensive. If we look at PEG, this is a good measure of, this is effectively the ratio of how fast earnings are growing and price relative to earnings growth. So it doesn't matter if a company's PE is high, as long as the growth is keeping up, the growth in earnings is keeping up with that high PE. But the problem here is that they're not, right? So price is outpacing earnings growth. So just bear that in mind. Things are still very expensive. And this is not just because of the recent gain. Even at the bottom of the sell-off, things were still expensive. Not just tech, other industries too. Solar, if you exclude it from tech, some infrastructure stocks, they're all still quite expensive. So just bear that in mind. Don't get too happy just yet. As a counterpoint though, this is the 1 year channel that the S&P 500 has been trading in since March last year, when there was the big sell-off, and we briefly popped out of the channel on the sell-off and we're back into it. So I breathed a little sigh of relief when we jumped back in. Otherwise I would be worried that the trend was broken, but it looks like it's still intact, albeit we're in the bottom half of the channel. So we'll see how things go. So for the past week or few weeks, you would have seen PIs and other investors talking about having a long-term mindset, and that what was happening in the market was normal, not to worry about it. Personally, I don't think we're in a bubble. Just by the way, I think maybe there are little bubbles in certain parts of the market, but overall the market is expensive, but it's not a bubble. A bubble is a high concentration of cash and prices that are just absolutely nuts. And prices aren't absolutely nuts, they're just high, and sometimes very high. Although in certain sectors, I think things are looking a bit bubblicious. So biotech or parts of biotech at least, and electric vehicles. So this is quite a nice Substack that I found. And if you are feeling a little bit nervous, it's good to look at your plan, first of all, and have a plan, look at your plan, and just understand where you are in the economic cycle and your plan, and just that helps you cement yourself in something. But also, look at some inspiration from some long-term investors. I think this guy is semi-famous, and I think he might work for the Motley Fool. But volatility is fine. I mean, it's just what happens, and you should be nervous when there isn't volatility. When there's volatility, I'm much happier. I feel much more calm than when things are just going up and up and up. And this is not how the markets work. It doesn't happen in a straight line. So it's really more of a zigzag. And yeah, so I like this. The bad news, good news. The bad news is stocks fall faster than they rise. But the good news is that they rise more often and for longer periods. There's another saying that encapsulates this, which is the stocks take the elevators. They take the steps up and the elevator down. So as humans, we feel losses much more strongly than gains. But you need to find your own ways to deal with your emotions when that happens. But it is a very important part of trading. So as I pointed out before, it looks as though we're seeing a nice big fat red candle in tech today. So indexes are selling off. These same indexes have had some great gains through this week. And so it was inevitable that they sell off. But what you can also see, so the thing that triggered, well, that everyone is saying has triggered the sell-off initially were US government bond yields, particularly the 10-year. And what we can see is that the 10-year yield, again, this is the 5-minute chart, is quite a lot up for the day. And so I expect this to... the market kind of forgot about 10-year yields for a few days, but now that they're up, if we change the 1-hour chart, and they are quite high, they spiked quite a lot overnight. I expect that markets will be looking at this, and this will drive part of a sell-off today, and maybe for a bit longer. The next thing that I wanted to talk about is that the Chinese market, there's lots of interesting stuff happening in the Chinese market. The focus a lot of the time is on the US market because it's quite exciting and things move a lot there. You know, everyone knows the S&P 500. They're the leaders of the Western world. But the Chinese market is also quite interesting because it's on the cusp of moving from a developing nation to a developed nation. And this affects everything. This affects their culture, it affects their politics, it affects the way the country is run, it affects the stock markets. And so in the past week, and I haven't heard much about this story, the Chinese government has been buying Chinese stocks. So China's had a liquidity issue that's been going on for a while. China's strategy for growth historically has been fairly risky, but it's worked. But now as the country is maturing, they need to transition from this more risky strategy, which was underpinned by a hell of a lot of fairly risky debt, into something that's more sustainable, a little bit safer for the long term. And so they've put the brakes on a lot of the riskier debt that they've been issuing, but that's been quite a bumpy road. They've found that this has had unintended consequences, and this has meant that the government has needed to inject liquidity into the market. Even though it had pulled liquidity, had stopped the generation of that liquidity, it is now having to reverse, well, maybe not reverse, but support the markets a little bit more than I think it had hoped to. And so this affects sentiment because the government had a plan, and the plan is, you know, the execution of that plan has been a bit rocky. But overall, I wouldn't say it's been anywhere near a failure. So Chinese stocks, particularly tech stocks, have been falling quite a lot through the past few weeks. I love a lot of Chinese stocks. So the US market is heavily overvalued, but Chinese stocks, the equivalent to Chinese businesses, which are as successful, if not more successful in some instances, are much, much, much cheaper. So because of this volatility, we're probably going to have to be quite patient. We're going to have the stomach to bear that volatility as it plays out. But I think that we are going to see a lot of upside from the Chinese stocks that we own at the moment. The other big news of the week is that the US government has finally approved their massive stimulus package. And this means that money is going to start landing in the hands of businesses and individuals. The US is also opening up, or part of the way through opening up. So that money is going to find its way into interesting places that it hasn't been able to get to, just in a lockdown world. And I've got my eye on upcoming earnings, and the earnings beyond that. And so we need to start anticipating where this money might land, how it's going to affect businesses and their earnings for the next few quarters. Something that's been going on in the background, which has gotten less attention, is that there's another stimulus bill US stimulus bill that's going to be coming behind this one. This is more a longer term bill, but it's going to be for a lot more money. So how is the US going to pay for the stimulus bill and all of these stimulus bills? It's going to have to be through tax, probably, especially since bond yields are so low. Although that might change. I think this is going to dominate headlines, but we want to think about how this is going to affect companies for the next 10 years, because this is a decade-long project, right? At least a decade long. Another thing to bear in mind is that the US isn't the only country that's doing this. So for those of you that watched the UK budget, the UK is creating an infrastructure bank, which is quite nicely capitalized. It's going to have a lot of money to execute its own projects, to fund projects, and also shape the way that infrastructure projects through the next decade or two are executed. And I expect this to be a theme through governments around the world. Infrastructure stocks and everything in that chain of infrastructure is going to see a lot of activity over the next decade or two. The world is trying to decarbonize mostly, so we'll still need to build bridges and roads and trains, etc. But there'll also be a lot of replacement of dirty energy with greener energy. It takes some dirty energy to replace green energy, so I wouldn't pull out of some of those dirty energy stocks just yet. But these are the kinds of trends that we look for. This is where we're going to see those double-digit and triple-digit growth stocks from, well, some of them in the next decade. What else did I want to talk about? Oh, so ARK. So ARK Invest, Cathie Wood and ARK Invest have been making headlines. ARK Invest, for those of you that have been keeping an eye on things, I don't have it open, but ARK Invest Innovation. If you look at the top components in ARK Innovation's ETF, you'll see these names, and there are a lot more holdings. These are just the top 10 holdings. But if you have kept an eye on the stocks that have been moving most, not all of them, but if you look at the stocks that have been moving the most, you'll see a large overlap between what is inside of ARK's ETFs. And the biggest gainers and the biggest losers in the US market there's been a huge overlap with what ARK owns. And so I'm not sure how much there's a bit of a chicken and egg question in my head. Is ARK affecting the market, or is the market affecting ARK, or is it a bit of both? I think that ARK's historical returns have pulled in a lot of new clients, people that are relatively new to the market, and they're the first people to panic when things get ugly. And so people selling off ARK Invest funds means that those stocks tank, and because those stocks are a large part of the wider market tanks. I think that ARK also publishes their the activity, their buy and sell activity within their ETFs, and so even outside of the ETFs, people that aren't customers are copycatting a lot of what ARK does. And so I think that ARK has become a powerful influence in the market, in the sell-offs, and in the subsequent rallies. So just try to bear that in mind. There's probably some exaggerated movement in the stocks that ARK owns. Although I think that ultimately ARK will be a winner, but you need to be willing to ride out the volatility for the next 5 to 10 years. Okay, so I spoke about the stimulus package. So I think this is going to be where money finds its way from where money finds its way into from the stimulus package will determine how things happen through the US market through the next few months. I think this infrastructure bill is going to dominate headlines quite a lot. For those of you that do read Chinese news, I think the liquidity issue may continue for a while and things are going to be volatile. So this will be through the next week, month, quarter. The other thing to bear in mind is that it's nearly earnings season again. So you will see some companies are beginning to report earnings quite soon. So through the middle to, let's say, the tail end of March, it's not a lot of activity, but there is some activity. And then in April, we're going to see earnings begin in earnest. A lot of people buy companies the week before a company reports or the day before a company reports. This is an awful idea. You are gambling if you do this. And if that's your bag, go for it. Or if that's part of your risk, if that's a small part of your overall strategy, fine. But for the average investors, this is usually quite a bad idea. Most well-run companies are highly strategic. And so the things they're doing today will usually only benefit the company 1 year, 2 year, 5 year, 10 years later. So it's very hard to predict how the very specific point in time that an earnings report represents, whether that's going to be up or down for a company. And so, I would argue that you can play stocks at latest 2 months prior to earnings, but you need to be very careful with your choices, and even then it's quite risky. So if you are going to play earnings, you probably needed to have started already, and if you want to play those in April, you better get your groove on. Okay, I think that's it for today. I hope that was informative. I keep on looking over here because that's where my notes are, by the way. I hope you have a great Friday. It looks like there's going to be a bit of a sell-off. Don't worry about it too much. And I will talk to you next week. Thank you.